Hi, I'm Taylor Dolenec,
And I'm Jordyn Frew.
and we're from the Finance 139 class with Shahrokhi. We did our case on Target and Walmart.
So, the first thing we have to consider is the shareholders. When looking at shareholders for these companies, they had a lot of the same shareholders, with the two top for both companies were Vanguard Group and State Street Corporation. When comparing Target and Walmart shareholders, we actually found that Walmart has more support from their inside employees and executives than Target. Target has 0% insider ownership, whereas Walmart has 51%. In addition, there are a greater number of institutions holding shares in Walmart than there are in Target. Therefore, we would favor Walmart for its variety in shareholders.
For question number 2, we had to figure out why investors care about our capital structure. And we found that Target has a lot of room for growth in order for their debt ratio to reach optimization. Walmart had a little over 2% more to reach their optimization. And therefore, the most favorable company based on the capital structure would be Wal-Mart due to the fact that they are so close to reaching their optimal debt ratio.
For the third question, we had to figure out the cost of debt financing. And we found that Target has a AA rating, which gives them a 3% pre-tax rate, whereas Walmart has a AAA rating, which is better than Target's. The pre-tax rate of Walmart is actually 2.5%. Also, we calculated the cost of debt with their tax ratings and found that Target's cost of debt was 1.97% and Walmart's cost of debt was 1.77%. After this analyzation, we found that Walmart was better because it takes on less risk and they have a higher bond rating.
So for question 4, we had what is our cost of equity financing? And according to our results from our analysis, we found that the cost of equity for Walmart is 2.7% and for Target it is 4.85%. The optimal cost of equity for Walmart was 2.71% and for Target was 5.24%. We also calculated the CAPM model, and for Target it was 3.765 and Walmart's was 2.37. Target is the more favorable company based on the cost of equity financing, and they also had a higher return for their capital due to their higher beta. We also did a 5-year monthly regression and a 2-year weekly regression, and in both of these scenarios, we found that Walmart was the better company.
So for number 5, we had to analyze the cost of capital for both companies, and we found that Target has the higher cost of capital. Although this is more risky, the return will be greater, whereas Walmart has lower risk, but it will still have a return about 2.52%, indicating that the minimum return is lower than Target's minimum.
For number 6, we had, could we lower the cost of capital by changing our capital structure? And we found that for Walmart, if we were to use the optimal capital structure of 30% from their current of 29.21%, it would decrease cost of capital by 0.04%, therefore decreasing their risk and at the same time increasing their value. And for Target, if we used their optimal structure of 40% from its current structure of 28.86%, their cost of capital would decrease by 0.06. And this would also decrease their risk and increase their value. With this in mind, we concluded that Walmart is better because it has lower cost of capital.
For number 7, we had to discuss which company would have unnecessary risk if more debt was created. And we said that there's an abundance of debt in Target, and it may indicate that the firm is too leveraged. So if Target increases their debt ratio over 40%, their bond rating would decrease to a BBB rating, which would indicate that there's a decrease in their overall value. Walmart has an optimization debt ratio of 30%. Currently, their debt ratio is already at 29.21%. So if they increase the amount of debt that their company holds, it will cause too much leverage and therefore decrease their bond rating as well. The company is so close to their optimization that it would be unnecessary to add any more debt. Therefore, we would favor Target.
So for number 8, it was how would a financial restructuring affect the value of our company? If Target were to restructure its financing, the company would have a 0.97% increase in their value, and Walmart would have a 0.79% increase in value. So after we found this, we concluded that Target would be the better company if they were to restructure its financing to their optimal debt ratio.
For number 9, we discussed what the other companies do in the industry. We found that Walmart was most favorable. When we looked at Walmart and Target side by side, along with Sears, Amazon, and Costco, we found that Walmart was most successful. It had surpassed competitors in terms of revenue and is behind Amazon for their market cap. The net income for Walmart also takes the lead, and Target coming in far second. Even Walmart's PEG ratio is at 16.76, which is dominating the competition by almost 15 points. Amazon and Costco are the other strong competitors in the general retail industry who actually outperform Target in some of the business aspects.
For number 10, we did a valuation of if the stock prices were fairly priced, and we found that Target's most recent share price is $69.95, and after doing an analysis, the share price was valued at $75.91. In this case, Target is undervaluing their stock. And for Walmart, their current share price is at $66.18. However, the analysis that we did showed that their share price was valued at $61.30. So their higher current share price indicates that the stock is overvalued versus Target's undervalue. In this case, Walmart is at the advantage for their share price.
After completing this case study, we found that Walmart was actually the most favorable out of all the aspects that we analyzed.